So, liquidity and human emotions, division 5. So the first thing you guys need to understand about emotions is you need to understand a little bit of neuroscience. Okay, that is the prefrontal cortex and the amygdala. So the amygdala is the part of the brain that's responsible for the emotions, and the prefrontal cortex is what's responsible for rational thought. Now, in situations which are emotionally heightened, the amygdala is often quicker to respond than the prefrontal cortex, which makes it easier to make irrational decisions over rational decisions. So when you're trading, when you're in front of the screens, you got the money, everything, you see the numbers, the P&L, prices moving up and down. Your amygdala is responding much quicker than the prefrontal cortex is. Okay? So you are more likely to act on emotion than ration. And this is something that is among all humans. All humans react to emotions. And whenever you react to emotions, you're typically making a mistake. Now, in real life, there may be more instances where the emotional reaction could potentially, by chance, be the good reaction. But in these markets, the emotional reaction is almost always going to lead you to losses. Almost always. Okay, the emotional reaction is all, and because that is a language that everybody reacts to. So if all of the money is doing something collectively, what is price going to do? It's going to go against it. Okay, it's going to go against it. That is human emotions. This is why there's also the saying, I'll think about it and I'll get back to you, because when you think about it, when you distance from the event, then you're no longer as emotional. Distance from event helps you be rational. Hindsight helps you be rational. When you read all of these heinous acts that happen in history, you can't really judge these people because you don't know what they went through at the time. You don't know how their amygdala was responding to what they were experiencing. And at the time, it would have seemed like the proper reaction based off emotion, but not necessarily based off of logic. And that is pretty much emotion. That's why hindsight is so easy, but real time is much harder. Now, convenience, this is a concept that I invented. Convenience rationalization. What is convenience rationalization? It is when traders rationalize through emotion, they rationalize the more convenient scenario as the correct one. They classify that as the correct one rather than the actual one that's good. So if there's two scenarios, one of them is supposed to be the good one of them is supposed to be the bad one, but the bad one is more convenient than the good one. It's easier. It's more convenient for you. Then you will think the bad one is the good one, and you will think the good one is the bad one. You will think the bad one is wrong and that the good one is right. Okay? Now, what am I trying to say over here? Where does this apply to the markets? Imagine we are in a downtrend, okay? So we are in a downtrend. Price is aggressively trending down. And now you see this consolidation over here like this. During this consolidation, it is much easier to go short, to go long than it is to go short. During this move down, it's much easier, it's much more convenient to go long than it is to go short, because the rational short, according to most strategies, is going to be way up here. It's going to be way up here. So it's much easier, it's much more convenient to go long. And in cases like this, most people are going to be knife catching. They're going to be trying to catch the bottom. And only once there's enough pain and price is fucked around enough, boom, now will it go up and it will not stop until it reaches its objective. So here, convenience rationalization, even though people were bearish, it was more convenient to catch the bottom. It offered more risk to reward. It was more attractive. So people were fighting this downtrend instead of joining it because they could not join it. It didn't offer them opportunities to join it. And that is why people would have been on the long side of this. And that's why price would have went down. Okay. And then over here, it would be more convenient to go short because now it's at your POI. So the stops are up here. So now price is likely going to boom because it's more convenient to do that. And now at this point, you're pissed. Now you're going to be like, okay, fuck it. I'm going to go long. And now they're going to distribute on you all the way down. This is liquidity and human emotions. Now, I already went over this part, so I don't need to go over it again. So let's move on to the next one.